Are gold and silver markets being manipulated? Today's market landscape echoes the 2008 financial crisis in one crucial way: the widening gulf between paper prices and real physical availability. In 2008, gold and silver spot prices collapsed. Gold briefly sank to $700 and silver to $9, yet physical metal was almost impossible to obtain. Major global mints, including the US, Perth, Rand, and Royal Canadian Mints, halted new orders or accumulated months-long backlogs. High net worth buyers swept inventories clean, and authorized dealers could only promise delivery at sharply higher premiums, completely disconnected from the artificially suppressed spot market. That was a classic paper market smashdown. But attempting similar naked shorting tactics today would carry existential risk. Silver is already in backwardation. Warehouse stocks on major exchanges are being rapidly depleted, and an increase in traders demanding physical delivery could expose a massive shortfall in the underlying metal. Such a revelation would send shockwaves through both the physical bullion market and paper vehicles such as SLV. A second major fragility sits within the Japanese carry trade, a pillar of global liquidity for decades. Japanese pension funds are now withdrawing more than $1 trillion from U.S. treasuries because hedging costs have erased any yield advantage. This pullback alone risks driving interest rates sharply higher. Meanwhile, trillions in borrowed yen have flowed into crypto, equities, and emerging markets. As Japan moves toward raising rates, that cheap money leverage must unwind. The result is a potential cascade of global margin calls. Put simply, the world's largest funding mechanism is cracking, and the public has little grasp of the volatility this can unleash. A striking disconnect is also emerging between institutional behavior and retail sentiment toward precious metals. Retail investors remain heavily concentrated in equities, even as margin debt hits record highs, and continue to overlook gold. Meanwhile, central banks, sovereign wealth funds, and commercial banks are aggressively buying bullion and removing metal from exchange inventories. Although senior strategists at firms like Morgan Stanley and Bank of America now recommend 20–25% allocations to gold, this guidance is not reaching everyday financial advisors or the traditional 60–40 retail portfolios. Gold has been so thoroughly sidelined in mainstream financial culture that even veteran money managers miss its fundamentals, despite gold outperforming both the S&P 500 and 10-year treasuries over the past quarter century. Driving this institutional shift is an erosion of global trust. Unlike the early 1980s, when Paul Volcker could crush inflation by hiking rates to 18%, today's debt-burdened world cannot withstand such measures. The only viable path is lower rates and continued currency debasement. The U.S. government is adding debt at a pace that undermines faith in treasuries, and even banks no longer fully trust one another, forcing the Federal Reserve to funnel billions into the repo market simply to keep liquidity functioning. In this environment, gold's appeal is straightforward. It is one of the few assets with no counterparty risk. It represents trust in a system that is rapidly losing it. In such distorted, intervention-driven, manipulated markets, it is increasingly unclear whether traditional technical analysis has any relevance. When central banks are openly manipulating market signals in an attempt to manage an orderly decline, many of the usual tools simply fail to apply.